we are. It's been the dumpster fire that is 2020. It's just been a hot mess all around. The good news is that, I mean, there is some good news, right? One of them is that we've recovered from what seemed to be like the end of the universe staring down at us earlier this year in March. And I think people just have been shocked at how quickly the markets came down and how quickly they rebounded. And were we in a recession? Are we out of a recession? And before we even have time to debate that, well, now we're dealing with the next crisis du jour, which is the election.
Right.
So people have had many reasons this year to feel maybe hesitant or concerned. And whatever those concerns were earlier this year, again, I think have taken a back seat to what's now on the top of everyone's minds, which is the elections. So can you give us a little bit of background in terms of how election results have played into the markets historically in broad brushstrokes?
Yeah, and this is it's a great place to start the discussion because when you look back over the last, let's call it 100 years, or even more than that, but let's go back to 100 years or even beginning of the 1900s. What you find is that markets, generally speaking, do very well under both Democratic and Republican presidential leadership. There is not a significant difference in returns for, let's just say, the S&P 500, no matter if you have a Democratic or a Republican person in the White House. If you look at the actual numbers, the detailed numbers of just the S&P 500 performance during the 4 years somebody is in office, and you run those numbers, and lots of people have run these numbers, they're not that hard to find, you do find that the raw numbers point to a slight outcome in favor of Democratic leadership in the White House, which sometimes serves as a counterintuitive idea when you think that Republicans are usually at least branded as being more business friendly, et cetera, which is why you have to take any of these numbers, any of this specific data with a really big grain of salt, because there are so many factors that go into equity market performance in any short time frame that is far beyond the scope of who happens to be in the White House. Presidential priorities and their plans and what they hope to achieve from a policy perspective, that takes a while to actually make its way into some sort of legislation. And you get legislation drafted, and inevitably it has a long period of actually, becoming, actually being enforced in the law. So you're going to give a 12-month heads up that tax rates are changing or whatever it might be, and so you have a delay there. And then depending on what the details are, actually having the impact of a policy change flow through to the actual economic numbers is also delayed further. It just takes a while for everything to kind of get filtered through the entire economic system. And so, is the performance in any 4-year period the result of that person who's in office now? No. It might be partially due to that, but it might be partially due to the prior regime who their policies are still filtering their way through the system. It's a very complicated idea to kind of paint, and it's way too simplistic to say XYZ parties in the White House, the market is going to perform better or worse given that scenario. Of course, the markets discount. They look into the future and they discount what they expect the companies to do, what they expect industries to do, and obviously market participants are discounting what they expect the political ramifications to be. And so you get this idea of kind of the delay in economic news reflecting policy, but the fact that markets are actually forward discounting that what they expect to be happening in 2 or 3 years, and you get a jumble of a lot of data, and it's way too simplistic to say, well, markets like low tax rates, or markets like governments that spend money on infrastructure, or something like that. And so the reality is far more complicated than any kind of single headline number might lead one to believe. But the bottom line is that over the course of decades and more than 100 years, markets tend to do relatively well under both types of leadership. And so that's kind of the bottom line point, is that making a big change in one's view on the markets or asset allocation or whatever, based on the potential for a change in leadership or the continuation of an existing leadership, tends to be foolhardy, because markets honestly don't care that much usually about which party is in leadership.
Great. Okay, great answer, Luke.